Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
Hello and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz. Let's check what happened overnight. President Trump's higher tariffs on exports hit dozens of countries, raising the average US import duty to its highest level in a century. Despite this, European shares registered their biggest daily gain in more than 2 weeks, with investors buoyed by a potential breakthrough to end the Russia-Ukraine conflict. On Wall Street, the Dow and S&P eased while the Nasdaq managed to close at a record high. Tech stocks rallying globally on relief that companies committed to US manufacturing would avoid tariffs. Apple shares rose after the latest tariff regime largely exempted the company from the threat to impose 100% levy on chips and semiconductors. However, chipmaker Intel fell after President Trump called for the resignation of the new chief executive, calling him highly conflicted due to his ties to Chinese firms. Eli Lilly raised its full-year profit and sales forecast, but fell after the release of its latest drug data. Block reported a rise in second quarter income and raised its expectations for annual gross profit, as the payments firm was helped by resilient consumer spending, lifting its shares 12% higher in extended trade. Shares of Fortinet plummeted after the cybersecurity firm gave a revenue forecast below Wall Street estimates. And Pinterest missed expectations for second quarter profit, overshadowing robust revenue and user growth, sending its shares down around 8% in extended trade. And President Trump has signed an executive order that will allow private equity, real estate, cryptocurrency and other alternative assets in retirement accounts. That clears the way for private equity and other fund managers to tap into trillions of dollars of Americans' retirement savings. Well, the US Customs Agency has begun collecting higher tariffs after weeks of threats from President Trump amid a flurry of trade negotiations with countries seeking to lower them. In a social media post, President Trump saying billions of dollars, largely from countries that have taken advantage of the United States for many years, laughing all the way, will start flowing into the USA. Well, the leaders of Brazil and India vowed not to be cowed by the president's hardline bargaining position, even while their negotiations have sought a reprieve from the highest tariff levels of up to 50%. Meanwhile, President Trump is nominating Council of Economic Advisors Chairman Stephen Moran to serve out the final few months of a newly vacated position on the Federal Reserve. He's previously advocated increasing presidential control of the Fed board. The Bank of England has cut its policy rate by 25 basis points to 4%, as widely expected, although it was a cautious decision, with 4 out of 9 policymakers voting for no change. The US 2-year Treasury yield rose to 3.72%, the 10-year was around 4.25%, and a 30-year auction saw a below-average demand. Markets are now pricing in a 90% chance the Fed funds rate will be cut by 25 basis points at the September meeting. The US dollar rising on reports Federal Reserve Governor Christopher Waller is emerging as the top candidate to serve as the central bank's chair. And the British pound rose after the Bank of England's split decision on rates. The Aussie has risen to 65.3 US cents, and Bitcoin trading above 117,000 US dollars. Oil prices have dropped for a 6th consecutive session after Russia confirmed that President Putin would meet his US counterpart in the coming days, raising expectations of a diplomatic end to the war in Ukraine. Brent crude futures down more than 0.5% at $66 a barrel. Copper's little changed. Iron ore at $101 US dollars a tonne. And gold buoyed by safe haven demand after the US tariffs came into effect. Spot gold up at around $3,390 an ounce. Let's get across the US equity market then, what we're seeing there. Dave Sekera is Morningstar's Chief US Market Strategist. He joins us again now. Dave, welcome back. Great to catch up for our monthly analysis of what you're seeing on the market. We talk first of valuations. What are you seeing there, I guess, particularly with those larger stocks?
Yeah, this earnings season has been a very strong earnings season. When I look at the stock coverage, that we have, the number of upgrades certainly outpaced the downgrades. I think is about a 4-to-1 ratio this quarter. So strong, very strong across the board. But yet at the end of the day, it's still all about the mega caps. And in fact, when I look at the total market capitalization that we increased our valuations this past quarter, only 5 stocks represent almost the preponderance of all of that market capital valuation increases. So just running through the numbers here, we increased our fair value on Nvidia last month over the course of July by 20%. That was after the US government allowed Nvidia to resume selling its H2O chips to China. Now, considering Nvidia's market cap is about 4.3 trillion US dollars, that's an increase of about $900 billion worth of market cap. That's like adding almost the entire market cap of Tesla to the index. We also increased our fair value on Microsoft after just exceptionally strong results by that company, again, raising it by 20%. That's a $4 trillion market cap company. It's another $800 billion in market cap. That's about the same as either JP Morgan or Walmart, which are the 11th and 12th largest companies in the index. We also increased our fair value on Meta by 10%. That's another $200 billion in market cap. We increased our fair values on Taiwan Semi and JP Morgan by about 170 billion each. So when you add those 5 companies up, that's $2.2 trillion of market capitalization that we increased our valuations over the past month. Just to put that in context, when you think about it, that's like adding 22 companies of $100 billion in market cap each. And to further put that even in more context, there's only about 140 companies in the US with a market cap of $100 billion or more. So again, the end of the day, it's still all about the mega cap companies.
All right. In fact, we'll get to some more pics of yours from Morningstar there post earnings. Just before we do that, Dave, what are you seeing the risks to equities at the moment?
Yeah, I mean, there's a lot of risks in the market. So the market right now is trading right about at our fair value today, but I just would prefer seeing a little bit margin of safety to help compensate investors for some of the risks that we see on the horizon. So of course, we still have the ongoing trade and tariff negotiations with some of the US's largest trade partners. So still ongoing with Canada and Mexico. Appears that the discussions are going better with Mexico than with Canada. And then we have the August 12th deadline coming up with China. Our understanding is we're still pretty far away from having any kind of agreement with China. Now, negotiations with China are going on in good faith, so we think that that will get extended further. When I look at our economy overall, our Morningstar economics team is still expecting that the rate of economic growth is going to slow sequentially through the end of this year and only begin a sluggish reacceleration in 2026. But it's really not just the US economy who's slowing. We expect that the Chinese economy will continue to keep slowing. The Japanese economy is slowing, pretty stagnant growth, out of the EU. So again, we're not seeing that economic activity that I prefer to see to really be able to back up a lot of the valuations that we see today. And then lastly, with the tariffs that you already talked about earlier today, inflation is expected to start to accelerate over the next couple of months. And I just don't think the US market really has those risks priced in here in the short term.
Are you going to see those now start to affect earnings, particularly guidance, as perhaps those companies no longer absorb those costs? They're also going to start pushing them on to consumers.
Yeah, and that's what we expect over the next couple months as the inflation metrics come out. They're going to show more and more of that inflation. And I am starting to get a little bit more concerned about the US economy, that there might be a chance that it's actually over the past couple weeks or months slowing a lot faster than even what we had suspected. When we looked at the payrolls numbers that were reported last week, those were just not only that were a disaster here in the US for last month, but they restated the prior 2 months numbers down to essentially zero at the end of the day. And looking at some of the most economically sensitive companies when they've reported earnings, for example, a lot of the chemical companies, especially the commodity chemical companies, their results were just awful. Those stocks falling, 20% or more in some cases. So I'm very concerned that if the precursors of, the economy, those commodity chemicals are slowing that fast, and I don't think the management teams really understood that when they gave guidance at the beginning of the quarter, prior to the quarter. I am concerned that the U.S. economy is actually slowing much more than expected.
Overall, Dave, what's your positioning at the moment?
So value stocks still have the best valuation overall. So we'd look to overweight value. That's trading at about a 7% discount. So I think that's probably a pretty good place to hide if we do have a bit of a market retreat over the next couple of months. Core stocks, those are the stocks that have some attributes of value, some attributes of growth. Those are pretty much in line with their valuation. So that's probably a market weight. But I still think you need to underweight growth stocks here overall. They're trading at a 16% premium to a combination of our fair values. Last time we saw them trade at this much of a premium was coming into the year before the DeepSeek news came out and all the AI stocks that were overvalued and overextended at that point, all sold off, 20, 30, 40% in some cases. And then going back even further, the last time we saw growth stocks at that much of a premium was the beginning of 2022, before we had, the much larger sell-off across the broad market, that year. Otherwise, we still like small cap stocks. I think I've talked about this for months now on the show. They're still undervalued at a 16% discount to fair value. They're undervalued on both an absolute basis as well as a relative value basis. There's a lot of negative market sentiment that's keeping those stocks down. I just caution investors, historically, those will do well when we're about to exit a recession or when we get to the point where the rate of economic growth is poised to start accelerating. We're not going to be in that type of environment for another couple of quarters. Usually those stocks do best when the Fed starts to ease monetary policy. We do think that will start here in September. And they also do well when long-term interest rates are falling. We're not there yet. We do expect long-term interest rates to come down. Our U.S. economics team is looking for 3.6% on the 10-year next year. But again, we're not necessarily in the environment today that small cap stocks do well. My thought here, though, is that what I've seen in the past, once the rotation out of large cap stocks into small cap stocks start, it works very quickly. And so I think you need to be involved in the small cap space. Otherwise, you could potentially miss that rally once it starts later this year.
All right, Dave, less than a minute. Just quickly, if you would, what are some of those picks you have post-earnings? You mentioned Microsoft. What else are you looking at?
Yeah, Microsoft, I think, is very undervalued. It's a 4-star rated stock at a 14% discount to fair value. We also like Alphabet. That's at a 20% discount. That's a 4-star rated stock. We think the market is just being overly pessimistic about the potential for the DOJ lawsuits to break the company up. We don't see that happening. And then another one that's one of our top picks by our technology team is Salesforce. It's a 4-star rated stock at a 23% discount. And overall, I like that one. I think it's a play on the theme that as the market starts to change its focus away from those companies that make the AI hardware to those companies that can utilize it, this is one company that should benefit from that over the next couple of years.
Dave, always terrific to get your view from Morningstar. Thanks so much for joining us.
Well, thank you.
Let's refocus then on the local market. Just before we get going on this Friday, we're expecting another negative start. SPI futures off around 0.3%. And of course, we're going to catch up with all the latest earnings results when we get going in just a minute or two. Stay with us.